It's great to have you both. Appreciate your time. Amy, we've been watching the VIX. We talked about the inversion earlier this morning. I guess so much for another 15 print. What's the future for the VIX, do you think?
It would surprise you a little. It's been pretty orderly in terms of what investors are doing. And what they're doing this morning is actually unwinding VIX positions. So essentially, they've made money on this VIX move higher, but they're saying, we probably think we've hit a local peak for now. And this was also true yesterday. We've had kind of historically high hedging demand, and all of that has been coming off. I think yesterday was a little preemptive given what is happening today. But overall, investors have come into this year very well hedged, mainly for the Fed, but they kind of got this geopolitical risk covered as a result of it as well.
Right. Yuri, it does kind of lead us to some discussion about the Fed. Some argue it's not a reasonable discussion to have, given how much we don't know about what we'll be facing come March. But what do you think the near-term playbook is looking like right now?
Well, if we look at the rates market and what they are pricing in for the Fed, at the peak a few days or about a week ago, the market was pricing in 6.5 rate hikes for this year alone, and 8 to 9 hikes over the coming 2 years to end the cycle basically at around 2.25 or so. That the market has taken away a little bit of that, but not a lot. And even if we look at the 10-year yield, we were at 205 last week. We were at 185 earlier this morning. We're in the 190s. So the move in the bond market really has not been as severe as the reaction in the stock market. And I think there's a clue in there, right? It tells us that, obviously, without minimizing the gravity of what's going on around us, it does come back to the Fed, right? And I think what the market either is focused on now or will be focused on in the coming months is that if the 2s to 10-year curve ends up inverting, and that's not a prediction on my part, we're still at about plus 40 basis points or so. But if that were to happen, and we see kind of the price of gold hinting at this, what would the Fed do, right? The Fed obviously is very aware of what yield curve inversion means for the economy. Would the Fed back off from any ongoing hawkish narrative and kind of tolerate higher inflation, or would it sacrifice the economy in favor of maintaining price stability? And I think that situation down the horizon, it really does not get changed by this. If anything, it might get compounded, because if the Biden administration throws the book at Russia in terms of very significant sanctions, and again, nobody knows if that's going to happen, but if that ends up curtailing the flow of energy into Europe, then that could, elongate the energy inflation. It means rationing energy for industry, which might again extend the supply chain bottleneck. So all of this still comes back to where we are in the rate cycle, and this doesn't really change anything as far as I can tell right now.
I mean, this is just a perfect storm, Amy, for the markets. And we just heard Kayla talk about the fact that some of the airspace in Ukraine has been ordered closed potentially into May. So if this geopolitical situation continues to stretch out over the coming weeks, over the coming months, just how much could that impact or compound, to use Urian's word, the broader market sentiment right now?
Yeah, look, I joke with my kids that my job is that I'm a professional worrier. And, I worry not only about the fact that right now the market is simply pricing kind of extended sanctions from the U.S., but not necessarily military involvement. But I also worry about the volatilities of Asia. What if China kind of looks to this situation and thinks about what they could or could not do with Taiwan? I don't think any of these tails are still, as of yet, priced into the market, even at a VIX with this 3 handle. Just remember, in the peak of the pandemic, we hit, over 80 on the VIX. There's a lot more room in volatility, even though everything on a percentile basis looks quite rich. And, I'm not in the business of saying, let's catch a falling knife here. I don't think you short volatility. I actually think you continue to find pockets to own tails and to own volatility if it does start to come off and people are monetizing any hedges they have on.
Shepard Smith here. Thanks for watching CNBC on YouTube.